Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, December 17th. This week wasn't a whole lot of fun. I spent half the week ducking and dodging the razor-sharp sickle of the growth market, the growth stocks portion of the equity market. Quite a bit of pressure on tech and growth. We've been speaking about that for a couple of weeks now. So it really accelerate this week. NASDAQ down about 3%, and some individual names really had trouble getting traction. Had plenty of safety in the defensives, right? Consumer staples traded very well. Utilities traded very well. REITs traded very well. So now comes the decision. And we've seen this multiple times over the last decade, and even since we've been doing these videos the last 2.5 or 3 years. We get to that situation where growth is weakening, and we have to make a decision: is it just a pullback, or do we have a reallocation trade going on? Because we do have a bit of a change from the Fed. We've had an accommodative Fed for really a decade. If we're talking about a 2 or 3 year period of rising rates, will growth be quite as powerful? I don't know the answer to that. Nobody knows the answer to that, by the way, because if you look historically in inflationary times, the only thing that really keeps up with inflation or competes with inflation is growth. So we'll see how that works out. In terms of how you want to be allocated, I think you want to still look at growth and value to complement each other. Remember last week, I thought last week's video was important. We took a look at the worst performing index, the Russell 2000. Year to date, it has trailed all the other indexes, whether it's the NASDAQ or the S&P, etc. Yet, it's still trading above that August-September low. So if you look at IWM, which is a ETF that represents the Russell 2000, even this week with the volatility, it closed above that August low. That's important information for us. If the worst index out there is still in consolidation versus breakdown, the market, for me, is trying to send a signal that some of the stronger areas, such as the S&P and the NASDAQ, are buyable. What I like to do in this kind of market where volatility rears its head every single day is take a look at names, either ETFs or individual stocks, that I really like, and circle an area 5 or 10 or 15% below where they're trading, and have an automatic buy at that spot. I'll give you an example. Adobe, a stock we own in Tactical Trend. It's not a large position. It's a 4 or 5% position. But had a 10% down day on Thursday. Adobe was 680, 685, 690 4 weeks ago. Today it's trading at 550. The long-term trend line, the uptrend line for Adobe, is right in the 520 area. I like to circle that area, and that becomes a buy point on Adobe. Keep in mind, it was just trading there a few months ago. Had a heck of a rally. It's pulled back. Uptrend still intact. We'll look to add on any further nasty pullback. You can do that with any name that you're comfortable with longer term. Pick out a spot where you feel there's reasonable valuation and put a buy order in. If it gets hit, it gets hit. That's one way to try to automatically take advantage of volatility. It's something that I've done with growth stocks in the past, and clients that have been longer term clients remember this same conversation we used to have about Apple. We'd say, if Apple drops from where it's trading today, and pre-split, let's just use $100. If we see $75 on it, it's an automatic buy. It turns the volatility to some extent into your friend. If you can make volatility your friend, in the right names, in names you want to own for 12, 24, 36 months, then you're taking advantage of the vol as a trader. So we'll see what it gives us next week, this volatility. Remember, that VIX that traded up through 30 multiple times 2 weeks ago warned us about this. And we talked about it 2 weeks ago. So now we're getting that volatility. Let's try to take advantage of it. John Mousseau will be discussing interest rates and the reaction in the bond market to the Fed meeting. The market's such a wondrous device. If I was on this video 2 months ago and I said in December the Fed is going to change their plans on tightening and raising rates from a 2022 tightening and some rates going up in 23 to tightening right now and maybe the first raise in March or April or Q2, you would think rates would have ripped higher. Today, the 10-year at one point traded down below 140. There's a heck of a battle going on there. You have a heck of a lot of traders here saying, you know what, I don't buy it. I don't buy this inflation. Okay? That remains to be seen. Moose will be keeping a close eye on that. He has the portfolio tight on duration, thinking that he'll be able to extend into higher rates. So he will be able to comment over the next few weeks on what he's seeing in the interest rate market. It will dictate an awful lot in bonds. Don't forget to like, comment, and subscribe to the video. And also, if you want automatic notification whenever we put on a video, turn on the notification bell. In terms of the holidays, enjoy yourself. We'll be on Thursday next week with the market closed on Friday. Have a nice weekend.
Hi everyone, it's John Mousseau. I am the CEO of Cumberland Advisors. It is Friday morning, December 17th. We're doing this a little early this morning on the bond side as I'm getting on a plane. This week, bond yields down. Look at the 10-year down from a 148 to a 141, the 30-year down from a 188 to a 183, and even 5-year and 2-year yields down as well. It is a surprising development in the sense that we saw the Fed this week come out and start to address inflation. How did they address it? They said that they are going to actually start raising short-term rates next year. The market is expecting 3 rate hikes, taking us from a 0 to a quarter right now, and probably a rate hike as early as March, where you'll get up to a quarter to a half, and then a half to 3/4, and 3/4 to 1% later next year. Also, the Fed starting to pull back on the amount of both treasuries and mortgages they're buying. Their tapering program, which they announced in November, speeding it up. So they will be done by March. So they're basically doubling down on tapering. This is the Fed's way of saying, boy, we need to start addressing some inflation. And the numbers this week really speak to inflation, right? We have things like import prices, surprising, now running at 11% up year over year. PPI came in at 0.8 for the month, now running over 9% year over year. So there's no question that the Fed is trying to address the fact that we will be serious about inflation. Clearly, the bond market is taking them at their word and saying, well, okay, Mr. Fed, this will not create a problem for us, and therefore, in our eyes, maybe this inflation is transitory. We think there's a long way to go till we see it. Again, our thought on this is that as you get out to further into 2022, this run rate of inflation will come down, but it's very hard to see how it comes down back to the 2% levels that we saw pre-COVID so much. More likely to settle in at 3, 3.5, maybe as high as 4 year over year. And at that point, bond yields should start to rise because then they know that the longer term trend of rates is going to be, of inflation is going to be at a higher level than they were used to. Along with that, we would like to say happy holidays to everybody who has spent the year viewing us. It's been a challenging year for sure. We hope you're all doing well, and we'll see you again before the end of the year, but we really want you to have a great holiday. Thanks a lot.